Assalamualaikum and hello to our lecturer and fellow classmates. We are from Group 5. We will be presenting our integrated case hybrid financing. The group members are Shafi, Shaza, Haja, Fatin and Irdina.
So we start with the first part of Fish and Chips Incorporated questions. Lease analysis. Martha Millen, financial manager for Fish and Chips Incorporated, has been asked to perform a lease versus buy analysis on a new computer system. The computer costs $1.2 million, and if it is purchased, Fish and Chips would obtain term loan of the full amount at a 10% cost. The loan would be amortized over the 4-year life of the computer, with payments made at the end of each year. The computer is classified as special purpose, hence it falls into the MACRS 3-year class. The applicable MACRS rates are 33%, 45%, 15%, and 7%. If the computer is purchased, a maintenance contract must be obtained at a cost of $25,000, payable at the beginning of each year. After 4 years, the computer will be sold. Millen's best estimates of its residual value at that time is $125,000. Because technology is changing rapidly, however, the residual value is uncertain. As an alternative, National Leasing is willing to write a year lease on the computer, including maintenance, for payments to $340,000 at the beginning of each year. Fish and Chips Marginal Federal Plus State tax rate is 40%. Help Millen conduct her analysis by answering following questions. Questions A1. Why is leasing sometimes referred to as off-balance sheet financing? If an asset is purchased, it must be shown on the left-hand side of the balance sheet with an offsetting debt or equity entry on the right-hand side. However, if an asset is leased, and if the lease is not classified as a capital lease, then it does not have to be shown directly on the balance sheet, but rather must only be reported in the footnotes to the company's financial statements. Question number 2. What is the difference between a capital lease and an operating lease? Capital leases are differentiated from operating lease in 3 respects. First, they do not provide for maintenance service. Second, they are not cancelable. Third, they are fully amortized. That is, the lessor receives rental payments that are equal to the full price of the leased computer system plus a return on the investment. What effect does leasing have on a firm's capital structure? Leasing is a substitute for debt financing or lease payments. Like debt payments, contractual obligations that, if not met, will force the firm to bankruptcy. Thus, leasing uses up a firm's debt capacity. To illustrate, if Fish and Chips' optimal capital structure is 50% debt and 50% equity, and if the firm leases half its assets, then the other half should be financed by common equity. Question B1. What is Fish and Chips' present value cost of owning the computer? In order to determine the cost of owning, it is first necessary to construct a depreciation schedule. This schedule is given below. So the depreciable basis is $1.2 million. The MACRS rate is already given at the statement before this. So to get the depreciation expense, we just need to multiply 1.2 million with the rate, so we could get the expenses of each year. To obtain the end of year book value, we just need to subtract the depreciable basis with the depreciation expense. For example, 1.2 million subtract with $366,000, so we could get $804,000. For the year 2, $804,000 subtract with $540,000, so we could get $264,000, and so on. The costs associated with owning are laid out on the timeline below. Maintenance is also known as operating lease, so it is deducted with tax rate. So we just multiply the maintenance amount with 1 minus T, which is tax. So we should get $15,000 for each year in the timeline. To get the present value cost of owning, we need to discount the net cash flow at 6% rate, and by using the financial calculator and using the uneven cash flow on the calculator at 6% rate, we should get minus $766,948 for present value cost of owning. Depreciation is a tax deductible expense, so it produces a tax saving of T depreciation. For example, the savings in year 1 is 0.4 multiplied with $396,000 equals to $158,400. The book value is $0, so taxes must be paid on full $125,000 salvage value, leaving $125,000 multiplied with 1 minus T equals to $75,000. We proceed to question B2. Explain the rationale for the discount rate that I use to find the present value. The discount rate used depends on the riskiness of the cash flow stream and the general level of interest rates. The cost of owning cash flows, except for the residual value, is fixed by contract and hence not very risky. In fact, they have about the same risk as the firm's debt flows, which are also contractual in nature. Further, leasing uses up the debt capacity and thus has the same impact on the firm's financial risk as does debt financing. Thus, the appropriate interest rate is fish and chips cost of debt. And since the flows are after-tax flows, the rate is the after-tax cost of debt. Fish and chips before tax debt cost is 10%. And since the firm is in the 40% tax bracket, its after-tax cost of debt is 10% multiplied with 1 minus 0.4 equals to 6%.
Okay, next we proceed with question C. What is fish and chips present value cost of leasing the computer? First thing first, we have to construct a timeline, start with 0 and end with 3, since the loan amortized annually at the beginning. The lease payment for each year, start year 1, is $340,000. Next, we have to calculate the tax saving, which lease payment multiplied with our tax rate, which is 40%. So we will obtain the cash flow after deducting the lease payment and the tax saving, which it will be $204,000. To obtain the PV, we have to use calculator, and by inserting our interest per year 6%, payment $204,000, FV0, periods 4, and compounding annually at the beginning. So the answer will be $749,294. Next question is, what is the net advantage to leasing? Does your analysis indicate that the firm should buy or lease the computer? Explain. So the formula to calculate the net advantage to leasing is PV cost of owning minus PV cost of leasing. Based on the question above, we already obtained our PV for the both. So $766,948 minus $749,294, and we will obtain $17,654. Since the NAL is positive, so Fish and Chip should lease the computer system rather than purchase it. Okay, now we proceed to question D. Assume that Million believed that the computer's residual value could be as low as 0 or as high as $250,000, but she stands by $125,000 as her expected value. She concludes that the residual value is riskier than the other cash flows in the analysis, and she wants to incorporate this differential risk into her analysis. Describe how this can be accomplished, or what effect will have on the lease decision. To account for increased risk, the rate used to discount the residual value cash flow would be increased, so present value decreased. Since the residual value is an inflow, the lower PV leads to a higher cost of owning. Thus, the greater the risk of residual value, the higher cost of owning, and more attractive leasing becomes. The owner of the asset bears the residual value risk, so leasing passes this risk to the lessor. Question E. Milan knows that her firm has been considering moving its headquarters to a new location, and she is concerned that these plans may come to fruition prior to the expiration of the lease. If the move occurs, the company will obtain new computers. Hence, Milan would like to include a cancellation clause in the lease contract. What effect would a cancellation clause have on the risk to the lease? A cancellation clause would lower the risk of the lease to Fish and Chip, the lessee, because the firm will not be obligated to make the lease payments for the entire term for the lease. If this situation change and the firm no longer needs computer, maybe they want to change to a more advanced technology, then it can terminate the lease. Conversely, a cancellation clause makes the contract riskier for the lessor. Now the lessor not only bears the residual value risk, but also the uncertainty of when the contract will be terminated. To account for the additional risk, the lessor will increase the annual lease payment. Plus, the lessor might include clauses that would prohibit cancellation for some period or impose a penalty fee.
Alright, next I'll be presenting the second part of the problem solving. As per statement shown, we can see that Martha Milon is asking for help in the decision process. So the first question is, how does preferred stock differ from common equity and debt? The differences are preferred dividends are usually set as fixed but might be omitted without placing firm in default. Meanwhile, most preferred stock prohibits the firm from paying common dividends when the preferred is in arrears, and preferred dividends normally cumulative up to a certain limit. Next, what is adjustable rate preferred? Adjustable rate preferred is an excellent short-term corporate investment because only 30% of the dividends are taxable to corporations, and the floating rate generally keeps the issue trading near par. The next question is about how can a knowledge of all options help a person understand warrants and convertibles. Both warrants and convertibles are types of call options, and therefore understanding of options will help financial managers make decisions about warrant and convertible issues.
One of Milan's alternatives is to issue a bond with warrant attached. Fish and Chip current stock price is $10, and the company investment banker estimate its cost of 20-year annual coupon debt with the warrants to be 12%. The banker suggests attaching 50 warrants to each bond, with each warrant having an exercise price of $12.5. It is estimated that each warrant, when detached and traded separately, will have a value of $1.5. Okay, question number 1. What coupon rate should be set on the bond with warrant if the total package is to sell for $1,000? Okay, if the entire package is to sell for $1,000, then V package equal to V bond plus V warrants equal to 1,000. It is expected that the 50 warrants will be worth $1.5 each, so V warrants equal to 50 times $1.5 equal to $75. Thus, V bond plus $75 equal to $1,000. So, we will get V bond equal to $925. Okay, next, we will need to solve for payment. So, firstly, we will using a financial calculator. We enter N equal to 20, interest rate per year equal to 12, present value equal to negative 925, future value equal to 1,000, and lastly, we will get payment is $110. Okay, so we will find coupon interest rate equal to 110 divided by 1,000. So we will get coupon interest rate equal to 11%. So with an 11% coupon, the bond will have a value of 925, and hence the package of one bond plus 50 warrants will be worth $1,000. For the next question, suppose the bonds are issued and the warrants immediately trade for 2.50 each. What does this imply about the term of the issue? Did the company win or lose? Okay, if the warrants traded immediately for $2.50 each, then the value of warrants is 50 times $2.50, and we will get $125. So, for the next, price paid for bond with warrants is $925 plus $125, and we will get $1,050. Selling warrant worth $1,050 for $1,000 increased cost per bond 50 per bond cost on shareholders, as the bond with warrants could have been sold with a lower coupon rate, consequently lowering future interest payment. So, the company will lose because the firm is paying more for interest expense as compared with bond with a lower coupon rate. For the next question, when will you expect the warrants to be exercised? Okay, holder exercise their warrant in below 3 conditions. Firstly, warrant will be exercised and buy stock if the warrant are about to expire and market price is above the exercise price. Next, warrant will be exercised voluntarily if company raises the dividend on the common stock by a sufficient amount. And lastly, warrant holder will exercise the warrant before the step-up price takes effect. The step-up exercise price is specified to rise if a warrant is not exercised before a decided date. Okay. Will the warrant bring in additional capital when exercised? If so, how much and what type of capital? Okay, yes, when exercised, warrant bring in additional capital in terms of exercise price, which is $12.50 per share in equity capital, and holder will receive 1 share of common stock per warrant. Next, because warrant lower the cost of the accompanying debt, shouldn't all debt be issued with warrants? What is the expected cost of the bond with warrant if the warrant are expected to be exercised in 5 years when Fish and Chips stock price is expected to be $17.50? How will you expect the cost of the bond with warrants to compare with the cost of straight debt with the cost of common stock? The answer is because warrants lower the cost of accompanying debt, still the overall cost is more than the cost of straight debt. Even the return with debt is fixed, but the return with attached warrant is based on the stock price movement, resulting overall cost to be more than the straight debt. If the warrant are expected to be exercised in 5 years with price of $17.50 each, then there will be an opportunity cost. Okay, 17.50 minus by 12.50 equal to $5. Since 50 warrants are attached with each bond, total cost per bond is 50 times $5 equal to $250. Here is a timeline of the cash flow stream. Okay, next, using financial calculator, the internal rate of return of this stream is 12.93%. The expected cost of the bonds with warrant, which is higher than the cost of straight debt of 12% and riskier than straight debt. However, the bond with warrant is less risky than common stock.
Question E. As an alternative to the bond with warrants, Million is considering convertible bonds. The firm's investment bankers estimate that Fish and Chips could sell a 20-year, 10% annual coupon callable convertible bond for its $10,000 per dollar, whereas a straight debt issue would require a 12% coupon. Fish and Chips' current stock price is $10. Its last dividend was $0.74, and the dividend is expected to grow at constant rate of 8%. The convertible could be converted into 80 shares of Fish and Chips stock at the owner option. Question number 1. What conversion price, PC, is implied in the convertible's terms? Conversion price is PC equal to par value over share received. Par value over CR equal to $1,000 divided by 80, and we get $12.50. The conversion price can be thought of as the convertible's exercise price, although it has already been paid. As with warrants, the conversion price is typically set at 20% to 30% above the prevailing stock price. Question number 2. What is the straight debt value of the convertible? What is the implied value of the convertibility future? Since the required rate of the return on 20-year straight debt is 12%, the value of a 10% annual coupon bond is $850.61 as follows. Using a financial calculator, N is 20, I over YR is 12, PMT is 100, FV is 1000, and solve for PV equal to $850.61. But the convertible would sell for 1000, PV equal to 1000, so the implied value of the convertibility is $1000 minus $850.61 equal to $149.39. Since each bond can be converted into 80 shares, the convertibility value is $149.39 over 80 equal to $1.87 per share. Question number 3. What is the formula for the bond's conversion value in any year, its value at year 0, at year 10? The conversion value in any year is simply the value of the stock obtained by converting. Since Fish and Chip is a constant growth stock, its price is expected to increase by growth each year, and hence PT equal to P0 times by 1 plus T power T. The value of converting at any year is CR times by PT, where CR is the number of shares received. Thus, the conversion value is any year is CT equal to CR times by PT equal to CR P0 times by 1 plus T power T. We will get 80 times $10 times 1.08 power T. For year 0, C0 equal to 80 times by $10 times by 1.08 power 0 equal to $800. Year 10, C10 equal to 80 times by $10 times by 1.08 power 10 equal to $1,727.14. Question number 4. What is meant by the term floor value of a convertible? What is the convertible expected floor value in year 0, in year 10? The floor value is simply the higher of the straight debt value and the conversion value. At year 0, the straight debt value is $850.61, while the conversion value is $800, and hence the floor value is $850.61. At year 10, the conversion value of $1,727.14 is clearly higher than the straight debt value, and hence the conversion value set the floor price. The convertible, however, will sell above its floor value at any time prior to maturity because the convertibility option carries additional value. Number 5. Assume that Fish and Chips intends to force conversion by calling the bond when its conversion value is 20% above the par value, or at 1.2 times by $1,000 equal to $1,200. When is the issue expected to be called? Answer to the closed year. If the issue will be called when the conversion value reach $1,200, then CT equal to 80 times by $10,000 times 1.08 power T equal to $1,200. We need to find T, and we will get the T is 5.27 years equal to 5 years. This value can also be found with a financial calculator. Input for I over YR is 8, PV is negative 800, PMT is 0, and FV is 102,000. Press N to find N, and we will get N 5.27 years is equal to 5 years. Question number 6. What is the expected cost of the convertible to Fish and Chips? Does this cost appear consistent with the risk of the issues? Assume conversion in year 5 at a conversion value of $1,200. The firm will receive $1,000 now, pay coupon payments of $100 for about 5 years, and then issue stock worth $1,200. The cash flow stream looks like this. For year 0, 1,000. For year 1, bracket 100. For year 2, bracket 100. For year 3, bracket 100. And for year 4, bracket 100. And for year 5, bracket 100, we will get 1,200 and 1,300. The IR of this stream, which is the cost of the convertible issue, is 13.08%. Note that Fish and Chips' cost of straight debt is 12%, while its cost equity is 16%. We will insert in the equation RS equal to D0 times by 1 plus T divided by P0 plus T equal to $0.74 times by 1.08 divided by $10 plus 8%, we will get 16%. The firm's convertible bond has risk that falls between the risk on its debt and equity, and thus a 13.08% cost appear reasonable.
For the last question, Milon are asking for some factors that she could consider when making her decision. So, my opinion would be the firm's future need for capital, because if the firm anticipates a continuing need for capital, then warrants may be favored because their exercise brings in additional equity capital without retirement of the accompanying low-cost debt. Conversely, the convertible issue brings in no new funds at conversion. Another opinion might need for some confirmation whether Fish and Chip wants to commit to 20 years of BES at this time. This is because conversion removes the debt issue while exercise of warrants does not. If the firm's price stock does not rise over time, then neither the warrants nor the convertibles would be exercised, and the debt would remain outstanding in both cases. That is all from our group. Thank you.